Thanks for coming back to another episode of Pitch It, a fintech conversation amongst founders, investors, and friends. I'm your host, Todd Anderson, Chief Content Officer at Fintech Nexus. And what we do is we take a peek behind the curtain. What motivates someone to start a company? How do investors make the right bet? What do accelerators do during and help enabling the process of growing your company? How do banks think of founders? Not to mention, we try to have some fun, and what you'll see is we'll also do some special episodes. We have some new features coming. So stick with us, and you'll get all you'll need to know about the fintech startup landscape. Pitch It is really a part of a larger podcast network here at Fintech Nexus. You can go to my colleague Peter, our co-founder and chairman, for Fintech One-on-One. You can subscribe to his feed, or we have our newest podcast by one of our writers, Isabel Castro, the Fintech Coffee Break. For everything produced by Fintech Nexus, you can check out Fintech Nexus Podcast, which is really our content fire hose. All shows, webinar replays, even in-person event content, not to mention our weekly news show. As always, we hope that you rate the show and write a review. I try to really take listener feedback seriously, and as it helps make the show better. You can also follow the podcast and all of our podcasts on the feed of your choice, whether it be Apple, Spotify, wherever you like to listen, or come directly to news.fintechnexus.com. Now, let's get on with the show. On today's episode, I'm joined by Lamine Zarrad, CEO and founder of StellarFi. Lamine and I discuss his unique journey to the US and to fintech, the inequities in the credit system, rebuilding your credit, say after a big credit incident that might have dropped your score precipitously, why they chose and the importance of being a public benefit corporation, the health of the US consumer when it comes to credit, banking regulations and failures. Lamine used to be a bank supervisor, raising capital, and much, much more. A couple of short PSAs before we get started. We're still accepting applications for Pitch It, so just head to fintechnexus.com. You go to our startups page on the site. The specific link to apply will also be in our show notes. And if you want to sponsor an episode, come on as a guest, sponsor one of our many digital or in-person offerings. Now is still a great time to buy your tickets, sponsor, and there's a couple of speaking spots still left to Fintech Nexus USA, coming up on May 10th and 11th in New York City at the Javits Center. Just go ahead and reach out to Todd at fintechnexus.com for details. Without further ado, I present Lamine Zarrad, CEO and founder of StellarFi. Enjoy the episode. Welcome to the podcast, Lamine. How are you?
I'm doing great, Todd. Thanks for having me.
Of course. I'd like to kick off. Just give the audience a little bit of background. Kind of what your journey has been thus far.
Of course. So I am founder and CEO of a company called StellarFi, which is a fintech platform that helps consumers build their credit scores, get more responsible with bill repayments, just be better borrowers in general, and then access capital, which is what consumers want. It's a pretty complex problem that we're solving, so it required quite a bit of effort. We didn't just stumble on this concept and build the idea. There are a few iterations, if you will. In fact, this is my third fintech that I founded and built. I built two neobanks before, Joust in 2018, Token in 2015. Token is pretty interesting because it was NFT play well before people knew what NFT meant. And we were operating in an industry that is pretty crazy to think about now, but back then there certainly needed banking, was cannabis space. We were helping legitimate cannabis businesses acquire bank accounts. Before my sort of a short but I would say very punchy entrepreneurial career here, I spent many years in financial services, between private sector, Merrill Lynch, USAA, Tudor Pickering Holt, to public sector, U.S. Treasury. I was a federal bank regulator with Office of the Comptroller of the Currency. and my team and I supervised over 36 nationally chartered banks. And so a lot of the lessons learned along the way are now sort of being productized and turned into solutions for consumers. And none of that is just kind of pulled out of thin air or AI research. But yeah, that's my progression. Personally, and I think this is an important thing to also mention, I'm an immigrant, and I came to this country after my family escaped a conflict in former USSR, now a country of Azerbaijan. Back then it was part of the USSR. And we fled across Europe, 7 countries, from Russia to Ukraine to Poland to Germany to Netherlands and a few countries in between. And that experience is certainly what drives me in my professional decisions, and sets the course for our current company for sure in terms of access.
So before we jump into exactly what you guys do and where ultimately the idea for StellarFi came from, did you see yourself or what was the drive to become a founder? You've had some public sector work. You've started a few companies now. Was being a founder and entrepreneur kind of always there, and it was, hey, I'm eventually going to get there? Maybe not now, maybe not in a year, but eventually I'll get there? Or did you stumble upon some problems through your personal journey you just mentioned, and maybe through some of the work you've already done in either the public or the private sector, that kind of you found these problems along the way?
That's a great question. It's one of those nurture versus nature questions, right? So I believe in both. I think any decision that we make, especially one as complex as starting a company, comes from a combination of both internal drive and who you are as a human being,
Yep.
and then your environment and how it shapes up and how it shapes you, and also and provides you with certain opportunity and access as well. You cannot omit either side. So just to give you a glimpse of my core, so to speak, as a human being, and why entrepreneurship is important to me. I was always very, very entrepreneurial, and I've had a lot of failures, or as we like to say in our space, lessons along the way. I started doing silly stuff when I was 8. I always loved animals, and I used to go to a pet shop down the street and go stare at those animals I couldn't afford to buy, different pets. And eventually would collect enough money to go buy a hamster, and I'll feed him for a couple of weeks and try to sell him back to the pet store. So that was like the very beginning of my entrepreneurial journey. And I've always think of things of kind of value investing, right? You buy something that's mispriced, and then you do something to it, make it more valuable, and then generate that delta. That was always like in the back. It was hard coded in me. I couldn't help it. But as an immigrant and as someone who comes up in an environment where there's not a lot of opportunity, you're not really thinking about being an entrepreneur in a direct way. It's not something that is available to you and you can build a career around. Whatever your environment tells you, man, you need to go study. You need to go get a good job that pays you money. And you start to believe that, and I certainly did. And I was like, well, this is what I got to do. I got to do these things the right way, quote unquote. I got to go to school, and I got to go get education. And if I get education, I'll get a good paying job, and my mom will be proud of me. And then eventually you kind of find yourself, dug into that career, and you realize that, crap, this is not who I am. This is not what I want to do. And for me, I felt the pain along every step. I knew that the deeper I went into kind of a conventional career experience, the more painful it became for me as an individual, because I didn't belong in any of those jobs. So I started to create things inside of companies. I became what's called an intrapreneur.
Yep.
I build widgets and tools, and finally realized that I just want to do this on my own. And when I had the means to do it, finally, enough of a network, I went ahead and did it.
So what brought you to the point of starting StellarFi, and while answering that, how'd you ultimately come to that name, StellarFi?
It's a good question. So my last company, Joust, was acquired by an Austin-based company called Zen Business. Zen Business is a legal tech company that provided small businesses with an opportunity to register their business, manage it, kind of like LegalZoom, right? And then Joust was a neobank designed for SMB, small businesses as well, to help them manage their customers, invoices, obviously finances, credit, and so forth. And so together, when we got acquired, we decided to reposition both operations to go after SMBs in a holistic way, in the way Shopify does it, for example. But instead of going after e-commerce businesses the way Shopify does it, we went after service-based businesses. These folks were DJs, they were caterers, they're the sort of home builders and various other things. And so we gave them tools, everything from compliance tools to marketing tools and banking tools. But one thing we couldn't do was credit. They needed access to capital. And we have been, really beating ourselves up trying to figure out how do we give them money, especially if you just form your business, you have no track record. You as an entrepreneur have a terrible credit score because, let's face it, all of us entrepreneurs have made decisions, and none of us have good credit scores. And we looked far and wide. Like, we looked at every partner out there. We talked to other companies that would potentially underwrite these businesses in a creative way. We looked at credit builders, various different secured products that would help them maybe build their credit so they can qualify for $1,000, $2,000. And none of that stuff really, stuck around. We really couldn't figure out how to do this. And, it occurred to me that what was missing out there was an incubator for a consumer. They're incubators for startups, right? Like, you've probably heard of Y Combinator and Techstars and so forth. For example, I take my company to Techstars, and what Techstars does is they bring you into the fold, they give you access to tools and resources, they connect you to people, and they hopefully help you find some capital, right? And that's fundamentally what we wanted to do. We wanted to create that experience for Joe Schmo. I just started a business, or I need help buying a house, or I want to buy a car. I need to know how to borrow money, where to find that money, how to get a best deal, right? And how to be better at repaying those obligations. And I became obsessed with that concept. And so, to a point where, I ended up resigning from that business and then starting Stellar officially. The reason we call it Stellar, we thought about a bunch of different names. We went through iterations. We actually, and no one knows about this, we were thinking about something entirely different. We thought about helping people buy homes first, something very specific as a first iteration, and decided not to go broader. And so the first idea was the name was called called Dwell, and didn't go anywhere. The reason we call it Stellar eventually, we were thinking about, how do you create this big visual, like this huge, massive opportunity, cosmic opportunity, right? And we thought Stellar, and then people use that already to explain things that are awesome, especially in certain sectors. When I served in the Marines, for example, I had a first sergeant who would always walk into the room and be like, "Oh, Stellar," and it just kind of stuck around back in my mind. I'm like, "Oh, this just sounds, it's crisp, it sounds big and amazing and just great. And who doesn't want stellar credit?" And so and that's what we decided to call the company, Stellar Credit, initially. And then we thought, well, we're more than just credit. We're fully, kind of a scaled financial operation. At least we want to be. And so we decided to call ourselves Stellar Financial and StellarFi for short.
So tell us exactly what you guys offer, what you do, and why when obviously researching for the episode, you guys chose to be a public benefit corporation. Why'd you go that route? Why is that important to you?
Yeah, for sure. Let me start with what we do and how we do it, and I'll kind of back into why PBC.
Yep.
So we, like any company, you want to start with something small and narrow, right? Something doable with a small team as a startup, and then expand from there. I think Mark Andreessen talks about the importance of your first building block when you build something, because it compounds. If you start with a wrong solution, even if you pivot into the right solution later down the road, it can have a negative lasting effect. So it's very, very important to select that very first thing, because it has to represent the big picture thing that you're doing in the most direct way. It has to be connected to it. Otherwise, it doesn't compound. And so we thought, well, we want to be this incubator. We want to be eventually a place that connects a borrower and a lender in a way that hasn't been done before, with a direct pipeline, with a way to qualify for lines of credit, for mortgages and so forth. Well, where do you start? How do you get the consumer? How do you build this marketplace? And it occurred to us that we could start with a very narrow message that will resonate with people, and it's let us help you build credit. It's familiar because there are many other credit builders out there. But then we didn't want to do what other credit builders do, usually secured products or unsecured cards. What we wanted to do is to address the problem of bad credit at its root. Instead of treating the symptom like most credit builders do, if you just join another credit building platform and you have bad credit, what they do is they create a secured loan, and it's a synthetic product. It's not a real product. No one takes any risks there. And it sort of distorts the true nature of you as a borrower, right? So you may be a bad person at the end of the day, and then you go to borrow money somewhere else, and someone else is left holding you back. We didn't want to do that. We want to help our customers be better borrowers. And the way we decided to help them to be better borrowers is by helping them pay their bills, because that's the reason why people have bad credit. If you don't pay your bills on time, you're not going to have good credit. And we said, instead of creating some fictitious thing to fluff up your score, we said, let's help you pay your bills. And if we can help you pay your bills, then you'll have better credit, right? And so that's where we started. So we created this bill pay product, and it allows you to link any of your bills, and you link your bills, we pay your bills on your behalf, and then you pay us back, right? And that's how it works. And it solves a whole slew of issues for our users, and it helps them bump up their scores much faster than any other solution out there. And also, shows up as a trade line in their profile, which is important to creditors. And at the end of the day, they're also paying their bills on time, right? So it's a kind of a short-term and a long-term solution. That gives us the ability to then bring a lot of customers into the fold, give them the tools that they need, but create this massive population of potential borrowers. So we now building the second phase of this product, which is the marketplace. Now, those individuals, they want money, right? They want money to buy a house, they want money to buy a car, they want money to buy whatever, something else. We want to give it to them. And the reason we decided to address this whole thing with sort of a public benefit corporation wrapper is because of the way we structure the product. The product is unusual because we're serving a population that's high risk. Let's be honest. If you have that score, chances are you've made some missteps, and you're going to expose a company to some risk. And the way companies offset the risk is through crazy fees, and this is why you have a whole industry around payday lending, right? If you don't charge fees or interest on the things that you do when you give someone money, it's kind of crazy. Usually it's the nonprofit land, but we wanted to create a for-profit corporation that was ethical, that was not predatory, and at the same time, we also wanted to signal to the world is that we're not here for just to be do-gooders. We're here to create this symbiotic relationship between us and our consumers, and also make money in a process. And so PBC kind of fit the bill as a structure for our product, where we're doing something to help people. Our mission comes first, but we also want to make money in the process, and everyone sort of walks away happy, right? In this relationship, I believe in conscious capitalism. I think it's the most efficient way to solve a lot of the social ills, and frankly, PBC is a great framework for it. The reason it's a great framework is because it forces you as a leader or the management team to actually codify what the things that you want to do that are not necessarily business oriented. And so what we ended up doing is we ended up committing a percentage of our profits to be given back to our community, meaning that our customer base in various different forms, grants, paying their bills off, that when they don't have the money, a number of other things that allows us to basically serve our customer better. But also, if you think about it, there's a pragmatic trigger there, or mechanics behind it, right? Where if you do these kind of things, more people will come to you because they want those things done to them as well. So anyway, hopefully that makes sense.
Yeah, no, that definitely makes sense. And I'm going to pick up on a point that you were making towards the end of your answer there, which is, fintech came on the scene, and post global financial crisis, the banks exited a lot of the lending space, especially to near prime and definitely to subprime, and they probably weren't even really helping subprime to begin with. But has fintech thus far made credit more inclusive and safer? I mean, it's it has this reputation of, hey, we're here, we use technology, we're going to level the playing field, but it doesn't seem as if it's really done that yet. And maybe it's given the tools out there, but the next step hasn't really happened, which is truly fair, equal access to credit for everyone.
Excellent. Short answer is absolutely. The fintech has done more for the population of underbanked and unbanked than I think the financial industry has done, and it's in the entirety of its existence, all the way back to Mesopotamia, right? And so in the past 10 years, there was more progress than all the progress in modern recorded human history. And here's why. Even if the company, like a fintech company, has tried and failed, and if it tried and failed in a big way, it still left a lasting mark that forced other companies to try to emulate it and do better and iterate on that model. And it created competition. It created competition not just between fintechs, but also between fintechs and banks. I mean, let's look at something very simple. Let's look at what Chime has done with early wage access. 2 days early pay, right? No brainer. Such a simple thing that you do. I mean, there are some banks that were doing it. USA actually has been doing it for a long time for service members, because USA figured out that the federal government always pays on those days. So we can take some risk and give you access to money 2 days later. But Chime did that for the population that could never access this service. And now it became table stakes, right? All the banks are competing to do 2 days early pay, which they don't take a lot of risk, because they know that if you have W-2 set up, they'll get instructions from your employer that, hey, we're going to be remitting, our payroll checks in 2 days, so they'll give you access to that money early. That's massively impactful for a lot of people. They don't have to go to payday lenders now because they can get paid 2 days early. I mean, Robinhood is another good example of influencing and completely restructuring the way trading is done. They took a bunch of risk. Most of it was really stupid, right? When you think about it, it's not pragmatic. They were like, let's just not charge anyone anything and create this new, new access for folks who never even thought about trading, right? Before it was completely out of reach. And now everyone, has a free product, which was unheard of. Like, not charging for trades, it's crazy. That will never work. And look at that. And so there are massive, massive, massive improvements. That is not to say that we solved the problem of, unbanked and underserved. That's a societal problem. Technology is not in a position to completely solve it, but we've made a lot of progress. And frankly, that progress is not slowing down anytime soon.
One thing you mentioned earlier was, a lot of the people that have a bad credit score probably had an event or something that caused them to get a bad credit score, either lost job or they got hurt and they couldn't work.
Yeah.
How difficult is it for someone to dig out of a bad score? And two, should it really be that hard?
Man, your questions are progressively more difficult to answer because there's so many variables. So how difficult it is to climb out. I mean, I can speak from experience. So I mentioned I was in the Marines. I deployed to Iraq, and because of the admin glitch, and it happens to a lot of service members, I don't get paid for 6 months, or I get partial paid. And so all my bills back home go unpaid. I'm not worried about it because I'm fed. I have a mission to focus on. I focus on these things. I come back and my credit is in ruin. And I use the power of the federal government, service members, Civil Relief Act specifically, to go to the lenders and say, hey, you can't do this to me. I'm a service member, I was deployed, restore my credit. And it works in some cases, it doesn't work in other cases. And my credit sucks, right? From that point, and still haunts me. That's almost 2 decades, right? I've learned a lot about how credit works and why it works a certain kind of way, because of that. How to sort of like game the system. Should it be that difficult? It's a hard one to answer because, frankly, in my case, it wasn't my fault, and things happen, and a lot of people are in the same position. Maybe you had a medical emergency. Maybe you just had an emergency where you lost your job. In many of those cases, I think we should have, off-gassing valves in that system, like, exceptions where, a creditor or the bureaus can say, you're right, this is not your fault. You're not a bad borrower. Shit happens. Let's reset the clock for you, right? So that doesn't exist. So I completely agree with you. I wish we had better mechanisms for those kind of resets. But for overwhelming majority of folks with bad credit, it's not just emergencies and missteps. Frankly, sometimes it's just that you deprioritized a bill of sorts, and you made other decisions in life, and without knowing that it's going to have a massive impact on your ability to borrow money going forward. But you did that, and you did that, and should that be forgiven? That's a hard one, right? Because now what you're doing is creating distortion in the system, and you don't want to distort the data. You want data to have as high of fidelity as possible.
Is it time that we come up with a new version of a credit score, massively change the credit score? And is that even possible? I mean, the way in which the bureaus work with lenders, how FICO works with mortgages, like there's very much entrenched ways this is done. So it's not like you can just go, snap your fingers and we can go to a new system. But should that be explored as like, hey, we're going to move to a new credit score in a generation, 25 years, and we kind of slowly build there?
Yeah, this is definitely not something you can snap your fingers. I wish I had a magic wand, right? I mean, to answer your question, yeah, I'd love to have a new scoring system that was more holistic, accounted for things that probably better indicators of whether you're a good borrower or not. The truth is, and I can't believe I'm going to say this, but FICO is one of the most effective ways to predict someone's repayment, going forward. Still is, statistically speaking, because they have decades of data, right? And they can predict very, very accurately whether you're going to be a good payer or not. The problem, however, is not that FICO is ineffective or bad for credit decisioning. Is that FICO is used for non-credit decisions increasingly more frequently. Like, should FICO be used by employers before they give you a job offer? And that's ludicrous, right? That they're going to look at your credit history and then make a decision on whether you're going to be a good employee or not. But they do. Should FICO be used by insurance companies to determine your insurance rates? Absolutely not. But does it happen? 100% of the time, right? Should FICO be used by I don't know, like any other decision maker, a landlord, for example, and giving you ability to pay rent? Probably not. And it's used. And so what I am worried about is that credit scores, not only are they not necessarily evolving, they're very much focused on the credit activities, but their adoption is spanning so fast and so far beyond their initial intent that it's becoming problematic in many different ways, that it becomes more of a good citizenship score. It is a score that follows you, that represents whether you're a good person or a bad person, and that's not an accurate estimation of whether you're a good member of the society just because you didn't pay some bills, right? And so that has to change. And I think the government is aware. For the most part, I know there's some legislation on the books that has been failing consistently, but I think the industry really needs to step in and say that, hey, if we're going to use scores to tell you how fast you can drive, that score cannot be based on your bill payment history. It needs to be based on something else entirely.
You've mentioned your time at both the OCC as well as a veteran. You're an entrepreneur. What are some of those lessons that you take from the time in public service that you take to your current venture, and that also that you provide to your team, because you have this wealth of knowledge and a fascinating personal story that I'm assuming not every person that works for you probably has that distinct of a story. So how do you use some of that in what you're doing today?
Good question. Finally, some softballs. Thank you. So many lessons, right? I'll start with the OCC first. OCC really gave me a really unique vantage point into the institution of banking, the one that you really can't replicate by working inside of a bank or working inside a financial institution. I worked inside of a bank, and when you're inside of a bank, you have a cubicle, and that's all you see, right, so to speak. You're segregated in a way to only see a tiny little portion of what's going on, and you cannot see the full picture of the entire clock. OCC not only gives you, a view of that clock, you can also see every other clock ticking around, in that space. And then you can compare those clocks and all the mechanisms and different, and I'm using that as a metaphor, obviously,
Yep.
but it was so unique for me to see how it's an ecosystem that banks cannot exist by themselves, not just those independent entities. They're connected to each other tightly, highly intertwined. So if one goes down, many others also will go down inevitably. And they're also how tightly intertwined they are with the federal government. Banks are not, we think of them as these independent corporations, but they're really part of the government in many different ways. Banks are used to implement policy, various different policy decisions, monetary policy, like controlling interest rates. Without banks, government can't do that. Banks are used for foreign policy decisions, like freezing assets for a country or some adversary and stuff like that. They're so important. So the government cannot let them fail. They can't let them make certain decisions. And so as a result, I could see what you could do and what you cannot do in banking. And so it influences what we can do today. That's why we get so innovative. We're all direct consumer, and we're fun on sort of on the face of what we do. But our DNA and what we do on the back end is incredibly innovative. It very much is grounded in regulatory arbitrage because we understand what works and what doesn't. So that's OCC. Marine Corps, and by the way, I served in the Marine Corps and the Army as well, which is pretty unusual, I think, but it was a really interesting experience in both ways. And so between Marine Corps and my experience in the Army, I was with an elite unit in the Army called LRSS, so Long Range Surveillance Unit. What I learned is that you can have an organization that's a high-performing organization like Marine Corps, but because it's so big, you have a lot of inefficiencies within that organization. And within that organization, you can also have units that are highly efficient and effective. And I wanted to sort of replicate the culture of those units that create the momentum for the entire organization. Because when you build something, you build a company, for example, you build really any team or any organization, you need to think about what are the drivers that are going to propel it forward. And it's usually these super elite, very competent teams that get a lot of stuff done really fast. And so I always think about some of the experiences there and trying to translate them into what we do today and creating that high performance culture. I think about how do you create these really steep on ramps into the company without being elitist, but still be exceptionally selective in who you hire. How do you create these really steep off ramps? How fast do you fire people who are underperform, right? Or do you give them an opportunity to grow and side and foster some of the talents? And a lot of those lessons very much derive from my experiences in both Marine Corps and Army, and I think they're super translatable. Also, to be really high level here, resilience. You learn a lot of resilience in the military because you constantly, kicked in the face, right? whether by circumstances or by the organization itself. And you learn to get up every time, pick up the pieces, and then start the whole thing all over again. And that is by definition the startup experience.
So, obviously, with your time at OCC, it'd be hard not to ask a related question to what's been going on. Obviously, we don't need to relitigate the collapse of SVB and others, but I really wanted to ask is, when you see bank failures like this, does it shine a light on banking that maybe some people don't fully understand how banks operate? And then secondly, how much better do people understand the risks that baby banks do take and are supposed to take as the way they operate? What are your thoughts on kind of some of that angle to what's been going on?
First part of the question, does it shine a light on the way banks operate, and does it? I think so, right? Excuse me. When banks fail, people finally slow down enough to start thinking about why they failed, and they're sort of uncover these things that no one knew existed. In case of SVB, and we won't go down that rabbit hole because I think it's been explored plenty in the past couple of weeks here. But SVB did everything that their respective regulators told them to do and authorized them to do. They didn't do anything inherently wrong. They were just operating like any other bank. They had a pretty healthy balance sheet. Their held to maturity assets. They're sort of losing value, but so is every other bank's held to maturity assets today, because they bought those instruments when interest rates were much lower than they are now. They did all the things by the book. Were there some strategic missteps here and there? Probably, but every other banking management team makes those mistakes. But under direct supervision of their respective regulators. And so I think what we learn here is not that we live in an environment where banks are making these crazy, wild decisions and is now paying for them. Is that I think the lesson here is that even with regulatory oversight, even with a framework that was tested and retested many different times, you can still see banks fail because they're inherently fragile as organizations. They are designed on one premise, is that you're not going to withdraw your money tomorrow. Banks run what's called decay test on their deposits. Decay test is basically derived from physics. It's like looking at nuclear isotopes. If you have $20 billion in deposits, how long does it take for that 20 billion to become 1 billion, right? And they base their entire operation on these decay rates of their deposits. And no one can predict how fast this will decay beyond natural sort of the rate of attrition. And so I think it really shakes us all up, because we sometimes forget that banks are human created, fragile, based on social contract type institutions. But ultimately, we have to remember that what's important is that the whole thing, the social contract, has to be in place. We have to trust the bank. They have to trust us back in order for this thing to work. The second one side or the other side loses that trust, the entire thing is a house of cards. It falls apart. And the entire society is built on that, on a social contract. And I think that's the most important lesson here. So that's part one of your question. I forget, what was the part two there?
Well, it was related to the risk, but I actually wanted to change the second question, which is, as someone who's in the space that you're in, how nervous do you get for the aspect of inclusion when a bank fails? Because ultimately, other banks are then looking around and saying, should we become less risk or more risk averse? And do fintechs do the same thing? And does ultimately inclusion get hit hard because of situations like this?
Yeah, I mean, I'm worried about this for sure. Banks don't think of whether inclusion necessarily should go and get marked off their list per se, because they know that the risk there with that population is it's pretty stable in a sense. It's risky, but it's stable. But what they are thinking about now, they're thinking about the relationships with fintechs that are serving that population. And now that sort of the entire tech industry has a black mark, on us, right? Kind of a thing. Like it's because of SVB's failure, because of the slowdown in venture capital investments. Everyone thinks that we're in a bubble that's about to go completely boom, and there will be no technology companies tomorrow. That's pretty human and normal for people to panic that way in scenarios like this. And it does worry me, because I'm afraid that this energy will sort of carry out new decisions that are going to be inherently very, very, very illogical and very sort of fear-driven, and it will kill a lot of companies in the space. And even if it doesn't affect our company, ecosystem is still pretty small and pretty fragile. And if it kills off a portion of that ecosystem, when I'm talking about fintech in general, it will most definitely ripple into every single one of the fintechs and affect them in a negative way.
One lesson and one regret that you can share with the audience about StellarFi that you've learned since you guys have launched.
One lesson and one regret. Lesson number one, and mind you, I've built multiple fintechs and I've dealt with fraud, but never get too comfortable in thinking that you understand fraud in its entirety, because fraud continues to evolve daily. And post-pandemic, launching a company post-pandemic, we have seen so many new creative variations of attempted fraud. It's mind-boggling. People are inherently brilliant. I don't care who they are, where they come from. They come up with the most crazy, most brilliant ideas to steal money. If there's a compensation at the end of that road, they will come up with ways to beat any of your smart algorithms. So that's lesson number one. The biggest mistake that we've made that I sort of regret. I'm not going to say that we haven't made mistakes. We certainly have. I'm trying to think of like most salient ones that would make sense to listeners. Let me pause here for a second. All right, I do have a mistake without casting any shade on any of the partners out there in the space. I will say this: as a fintech, you have options these days to work with other fintechs, right? Fintechs are really compilations of a bunch of different tools. When you build a neobank, or when you build any kind of platform, it's actually humorous that it's usually like a Lego of a bunch of different pieces that you kind of put together. It's rarely like in-house stack, right, that you build.
Yeah.
And it's very tempting to go to market with with a Lego stack like that. But I think one of the biggest mistakes for us is that we went with a more established, quote unquote, incumbent that provides those kind of services, and we worked with them in the past. And knowing that they're slow, knowing that they're not very efficient, and they certainly wouldn't be able to keep up with our pace of development. Well, yet we still did it because we thought that the core offering was good enough. And man, we were wrong in such a massive way that before we launched the product, we were building for months, almost half a year. And then right before the launch, we had to rip them out and then build our own stack, in haste. And it took us like 4 weeks to rebuild everything. And it wasn't perfect. And the product came out very crude. We still, kicked ass. We still grew to 2 million in ARR in the first 7 months after going live. And that's a testament to the problem and that we were solving and the need out there, not necessarily the quality of our product. But the product has evolved since then. But man, that was such a painful lesson and a mistake. And we knew that this that could be the outcome, but we did it anyway. And sometimes you have to.
Tell us more about kind of what size of the team today. What's the makeup of the team? Engineers, product, sales. What about those around you?
For sure. So we're a little bit over 23 full-time employees, and a little bit over 30 with contractors. Some of them part-time, some of them full-time.
Mhm.
So the team is small and nimble, but sizable enough to handle the kind of scale that we're dealing with. The team is sort of split, I would say, into kind of three categories, and almost evenly matched size-wise. Product engineering is one of our biggest groups, in the company. I would say that's definitely 1/3. The other, component there is operations. We are growing our operations because we have to manage risk. We have to manage, member support. All of that sort of like falls under finances and management of the funds on the back end falls into operations umbrella, and there's many different types of skill sets there. And then last but not least is marketing, right? So marketing is, we're a direct consumer company. Marketing is a massive part of what we do. And that's the last leg of that stool.
I see that you guys have raised some outside capital. How was the fundraising process?
Yeah.
And what'd you learn? You've had some other companies beforehand. You probably had some good lessons from those times. But what'd you
Yeah,
learn about your company through talking with investors, pitching the company?
for sure. So I know that we can cut this out. There's someone vacuuming next door. Do you mind if I close the door real quick?
Sure.
Yeah, I'll be right back. All right, apologies about that.
No
Um,
problem.
yeah, so we are under embargo for this press release related to fundraise until 28th. So can I say it? I don't know when you're running this story.
Yeah. You could say we're going to do it after you guys have that out. So,
Oh, perfect.
yep.
Cool. So we've raised a very healthy seed in 2022 in the beginning of the year. So we sort of we're certainly beneficiaries of what was going on in 2021 and 2022, without a doubt. But having had a very successful track record certainly helped, and having a team that built a unicorn before certainly helped as well. That 7 million gave us a lot of runway. It gave us fuel to really like run out the door as fast as we could and outrun the competition out there. Of course, the product and the clever way we market ourselves, many different things that came together there. But that created this foundation, very strong foundation for us to then get out there and raise a Series A, despite the meltdown, right? Despite the fact that VCs were recoiling starting mid last year, certainly now. We were able to close a very aggressive 15 million Series A, where virtually everyone advised us against it. We were told that, well, get out there and just do an extension or to your seed, or do a very small modest Series A, because you'll never be able to close this, not in this environment. But when you have track record and when you have a traction, more importantly, when you have a business that is just booming, and even in this economic downturn, you can leverage those things. That's essentially what we did. The reason we were able to raise, it's not because our personal backgrounds on the team, although I'm sure it helped some way. It's because the company grew to 2 million ARR in 7 months after launching, which I've never been part of the company. And like I said, I've built a unicorn before. I've never been part of the company that's done this this fast. It's because the company's margins are incredibly efficient. Unlike most fintechs, our margins look more like a SaaS product margins, because our market is immense. I mean, we're targeting 150 million Americans today with this existing product. As we expand our features, will be anyone who pays bills, right? And not just the United States. And so all the opportunity is so big, and the execution is so well done that we were able to close the round. But don't get me wrong, it was still a fight. It was a dog fight. In fact, it was pretty nasty in many different ways. Because everyone was shopping for deals at that time, and even if they see that you have a good company, you start sort of comparing it to other deals that are available out there, because it's such a delta between what we were asking and what other companies were asking investors. we're just kind of feeling this dissonance and wanted to like drive our price down.
We have just a few minutes left before we get to some fun questions to finish. What would be, as a multiple time founder, what would be a piece of advice if a newly minted founder picked up the episode and you gave them one piece of advice to walk away with?
Yeah. So for a newly minted founder, just remember, you gotta be resilient. The truth is, no matter how smart you think you are, no matter how great you think your idea is, you will fail, one way, shape, or form. And I don't mean the company will fail, but you will experience many different micro failures along the way. And success, and this is a cliche, but success is a compilation of those micro failures, not because those failures somehow shape this whole big picture, is because you survive them, right? It's about resilience. It's a single most important quality. It's just like keep doing it. Keep doing it in a smart way, not in a dumb way, not trying to replicate the same mistakes. But make a mistake, pivot slightly, try another thing, make a mistake, pivot slightly, try another thing. And frankly, being a multi-time founder, that process doesn't really change. You just do it much faster and with much more fluidity, where it feels like you're executing with surgical precision, but really you're making the same mistakes. You're just pivoting much faster and much quicker, and no one is noticing those pivots.
So we have just a few minutes left. A couple of lighter questions to finish this off. Do you have a favorite book or the last book that you read?
Yeah, so I read some business books. I'm actually not a huge fan of business books because I feel like a lot of them are contrived, and examples are so unique to those particular businesses. You can still extract value from them, but I like to read military strategy books, and because for a couple of reasons. It's independent of business, but human societies are organized themselves around very similar concepts and fight over the same stuff. We're always fighting over like market share, really, at the end of the day. And so the most recent book that I'm almost finished with it, so I haven't completed the book entirely, but I love it, and I think it's one of the better military books for startup founders. It's called The Ghost of Cannae. It's about the Battle of Cannae, where Hannibal, who I'm sure a lot of readers or listeners here heard about, crossed the Alps with elephants and defeated Rome, right? The underdog, if you will, defeated the most, let's say, the most powerful civilization of the time in terms of like military prowess, with a band of kind of outcasts, a bunch of Gauls, a couple of Spaniards, some Libyans, some Numidians, and just kicked their butt in a way that that's still the highest casualties ever experienced in human history in one day of combat. So close to 50,000 people died in that knife fight in 24 hours. And it was a decisive victory for Carthaginians, led by Hannibal, not because he was smarter than the Romans or better equipped than the Romans or better supplied than the Romans. It's a true startup story. It's because he learned so many micro lessons from every single defeat along the way. They kept applying them and twisting his strategies, where he would basically it would be like 2 or 3 steps ahead of the Romans, because he could adjust much faster. He took more risk and he moved faster, so to speak. And to me, that's the essence of success in the startup world. And if you want to read that book, I highly recommend it.
Founders always need to refresh their minds and not burn out. What do you do to kind of reset and make sure you're fresh for you and your team?
Yeah, so I try many different things. I don't have one magical thing to reset. Exercise, I kind of got back into it. I always oscillate. I either like go without exercise for a while and get back in. So what I did, I actually created, I learned that I have to be very organized around my health and wellness. And so I created in Notion, in a very nerdy way, I created an entire plan with reminders, with various different things. And I've divided my health and wellness into physical wellness, medical wellness, mental wellness, that includes emotional wellness, family wellness, and financial wellness. And these are like sort of like my columns with a bunch of stuff that I do. And having put everything into that one piece, one view, like actually brings me a lot of, I don't know, serenity and calmness. And because it reminds me, it's sort of like I've outsourced all of the concerns and worries about my personal life to that, spreadsheet, if you will. That helps me sort of like, stay stable. But yeah, I do. I meditate. I work out. I ride a mountain bike outside. I have a sailboat that I occasionally sell. Yeah, I mean, I do things that progressively more fun things as I can afford them as a founder. But yeah, you just get away with running outside, when it's nice.
Do you have a favorite sport or sport team that you root for?
So I've never been into sports, especially not team sports. I've always been into kind of combat sports personally. But I have a 10-year-old who is into basketball, so he's getting me into basketball, and I've been, because he's playing, I'm obviously following him, and because he's obsessed with NBA, I'm starting to follow NBA as well. And so LA Lakers is his team, and by association, it is my team.
Do you have a favorite vacation spot?
I do, actually. So we discovered as a family, because we live in Austin, Texas, and we have children, we discovered that there's a direct flight from Austin to Cancun. And although I personally don't like the hustle and bustle of Cancun, there's a tiny little island just about 45 minutes northeast of Cancun called Isla Mujeres. And it's beautiful, it's quaint, it's got, all of the amenities that you want in a vacation destination. And it's away from like the craziness and of Cancun. So we like to go there frequently.
And then final question, what inspires you? What's your biggest inspiration?
In what way? Like inspires me to
Just inspires you to get out of the bed, to continue going as a founder, like kind of what keeps you going?
What keeps me going is the prospect of changing culture entirely in this country and eventually globally, changing, completely reinventing the relationship between a borrower and a lender, meaning that we are kind of re-engineering the nature of credit, something that hasn't been done in the entirety of human existence. And I think we're well on our way in doing that. And that's such a massive step in just human evolution, so to speak, and social evolution that scares me, but it also inspires the hell out of me to get my butt out of bed and do this.
Well, Lamine, I greatly appreciate you taking the time out to chat with me. If someone wanted to get in touch with either you or StellarFi, how can they do that? How can they reach out?
Yeah, so the best way is to go to www.stellarfi.com, and you can find all of your resources there. And you can probably reach out to me directly through StellarFi.com. I still monitor all of the outreach that comes to hello@StellarFi.com.
Sounds good. Well, I appreciate again you coming on the show. Continued luck to you and the team, and hopefully we'll get you back sometime in the future.
Thanks for having me. Really enjoyed this.
Thank you.